So that's what we're going to talk about tonight. But before we get started, I just want to make a couple remarks. The Institute for Caregivers is an education program that is offered to the community at no charge in a collaboration by the County Office for Aging, Onondaga County Office for Aging, and the Alzheimer's Association of Central New York. So we work together every year to have a spring series of classes, a fall series, and we try to have a variety of topics that we feel will be helpful to family caregivers in the role that we have chosen. But actually, we really are serving the public now because more and more people are wanting to become informed about the issues that we are bringing to our classes. So we're having a more open view about who is the market for our classes, and that really is our community.
Where do we find out about these? Because I just happened to stumble on it.
That's a good question. Every semester or every spring and fall, we publish a catalog of classes that lists the classes where they are. If you put an asterisk by your name or on the comment form, if you put your name and address somewhere there, I will make sure you get on the mailing list. How's that? And I'll put one in the mail, the current one, when I get back to the office, so that you'll have that current one.
They're also on our website.
Pardon?
They're also on our website. You can download the brochure.
Oh, yes. Oh, here, yes.
And they're at libraries to pick up.
And they're in the library. We have them in all the libraries. But they are on the website, ongov.net/aging. And you'll open it up and see Institute for Caregivers. Yep. Thank you. I'm so used to my old-fashioned paper copy of Life here, of Life. On the comment sheet that you all have, I really encourage you to put a response, because this helps us plan topics and subjects, and any comments you have or suggestions we take very seriously, and the program is built around input from the public. So please offer your ideas so we can at least consider them, and I thank you for that. Before Jim starts, Melanie, do you have a word?
Did you have some stuff you want to talk about
I will,
first?
but why don't
After
you?
me? Okay. So I'm Melanie Beecham. I'm one of the Associate Program Directors with the Alzheimer's Association. We offer a variety of different support services across the community for caregivers and people with the disease as well. I don't want to take up too much time, so I have a variety of information on the back table, and I'll be here at the end. So if anyone has any questions about anything that we offer, just let me know. Thank you, Cynthia.
Thank you, Melanie. Just a couple of things I want to bring to your attention, and there's some flyers for all of these on the back table. One is the celebration luncheon for all the seniors in Onondaga County that's coming up, and that's May 17th. It's at Drummond's Club, and it's just wonderful. It's a time that seniors come together and have a wonderful lunch and a short program. So if you want to pick up a reservation form, you can pick this up and send in your check for $5 and register for the luncheon. Another date you might want to keep in mind, maybe I should do these in order. On May 19th, the Elder Law Fair is taking place. Have any of you ever been to the Elder Law Fair? Oh, you have.
Yeah, Judge C. It was at the Roundy
Once.
years ago.
Now it's at Onondaga Community College. Yeah, that's where we've been having it. But this is a program, a morning program that offers a variety of workshops on a whole variety of topics having to do with elder law. And it's a free workshop, so you can pick up a folder or a flyer and consider going to that. And the next event I want you to think about is the Elder Abuse Conference, and that's going to be on June 15th. The flyer for that is also on the table in the back. So just call those things to your attention and consideration. Jim Connell has been working with us for a number of years because, again, input from people who come to our classes have said, oh, it's the money issue that really bothers me. I don't know how to do it. I don't know where to go to get good information. So Jim has helped us out with several classes over the years talking about this, how we can finance medical care, what are all the options, what are some of the things we need to ask ourselves right? The do's and the don'ts. Jim Connell.
Good, thank you. Thank you for coming out tonight. And as we go through this, I think you'll see over the years that there's been a lot of changes in the different things that can be used for financing, not just healthcare, but long-term care as well. And so a lot of this material, some of it will apply to you, some of it won't. But keep in mind that you're going to be coming in contact with other people that may have questions. And so just a lot of the things you'll hear tonight are things that you might be able to pass on to other people. And recently, this presentation, just from feedback that I've gotten from people, as people have come to different workshops, they've said, you know, why don't you spend a little time just talking about, you know, not just long-term care, but also Medicare and some of the other expenses that we might incur. So I really, you know, added that to the puzzle of things that you have to think about. And really, from a statistical standpoint, I stole some of the slides from a nationwide presentation because they did such a good job covering the Medicare part of it. But 77% of Americans say that healthcare expenses in retirement are their greatest concern. And as a financial advisor, it's probably, most people that come into me come in for financial planning, but second to their money and having enough to retire on, the second biggest question is, what are we going to do about healthcare if we retire early? What are we going to do about Medicare? Do we need to keep our health insurance? What are we going to do if one of us needs long-term healthcare? So these are big issues that people are concerned about. And of course, you hear it all the time in the news. It's an ongoing conversation. The two areas that are probably the most important, and the two that you hear about the most, are your medical costs in retirement. And those are your doctors, hospitals, and prescriptions, and then long-term health care. So we'll jump in, and I think one of the things from a healthcare standpoint, when we think about doctors and hospitals, really what you've got is that 45% of all costs in retirement are going to be cost-sharing provisions of Medicare. So just a lot like your health insurance and other things, Medicare has deductibles. It has co-pays. It has different things that you have to pay for when you need care. The second largest part of your expenses in retirement for Medicare are your premiums. Part A has no premium, but parts B and D, part D being your prescription drugs, they both carry premiums. And those are monthly premiums that if you enroll in those programs, you're going to be paying. So, and then the last part, the other 23% of what you incur in medical expenses, they're just out-of-pocket prescription expenses. And included in that out-of-pocket prescription drug expenses are things like eyeglasses and dental care. So, you know, we think of prescriptions primarily as being our pharmaceuticals, but from a Medicare and from a retirement standpoint, you know, prescription eyeglasses, things like that, they're typically not covered, or if they are, very little. So you can see really out-of-pocket expenses over the course of retirement for a married couple is estimated to be between $255,000 and $360,000 during a married couple's lifetime from 65 until they pass away. Now, fortunately, that's not all due at once. So these are a lot of it being incurred over time.
How much of that would be nursing home expense?
Well, that's not actually covered on this slide. So this is really strictly related to your health care, meaning doctors, hospitals, that type of thing. Yeah, but good point. Can you guys see this okay? Is it bright enough? Because the lighting in here is a little bit bright. Okay. So what you have really once you hit age 65, and for a few people there's some exceptions to that prior to 65, once you go on Medicare, you've got Medicare Part A and Part B. You've got typically a secondary insurance program. And we'll talk about some of those gaps and those deductibles. And then you also might have prescription drug coverage. So that's down the left-hand side. That's one option. where you're paying for Medicare, you're paying for a separate insurance policy like a Medicare supplement, and then you're paying for prescription drug coverage. The second option is what's called a Medicare Advantage plan. And that's where essentially you're turning over all of your services to an insurance company who's going to manage Medicare and all of these other pieces on your behalf. And these are two very different programs. And the focus is not to cover those in detail, and I'm not really even an expert on those. But as you begin to look at, and each year you have the option of changing during the open enrollment period, you can go from this type of program to an Advantage program. And the Advantage programs typically have premiums anywhere from $0 to a few $100s per month, and it depends on your income. It depends on your health conditions. So if you are somebody who has very few health conditions, very few prescription drugs, somebody who's knowledgeable in those plans can typically get you on a very low-cost Advantage plan. If you have a lot of medical conditions, you may be better off in option one, where you've got regular Medicare and then some additional secondary insurance. But it really depends on your situation. So as you approach every year, as you approach that open enrollment period, which is in November and December each year, it's helpful if you can meet with somebody either from the county or from a private insurance company that can guide you to help you to get the best coverage. And a lot of you have probably already experienced this, or at least on somebody else's behalf, you talked about it. This here, GHI, refers to group health insurance. So if you were fortunate enough to work for an employer who continued your health coverage beyond retirement, then you may have original Medicare, plus that group health insurance then covers the gaps after that. Okay? Any questions on that? Some of these numbers have been updated, so they might be a little bit more. But this is Medicare Part A. This is your hospital insurance. And everybody who turns age 65 gets Medicare Part A. There's no premium due for Medicare Part A. And it covers inpatient hospitalization, skilled nursing facilities, home health care, and hospice. Now, when it covers these things, you'll see your first 60 days, there's a $1,200 deductible. It's actually about $1,300 in 2017. So that's what you're paying out of your pocket. Days 61 to 90, it goes up. Now you've got a $300 plus copay per day for your care. And then days 91 to 150, it jumps to over $600 per day. This is what you're paying out of your pocket. And then days 150 plus, you're responsible for all of those costs if you were to be hospitalized. Now this is where these separate deductibles and copays, this is where the supplemental insurance comes in. So if you buy a supplemental policy or you have an Advantage plan, these costs for the most part, in varying degrees, are covered by that additional policy. Now, you'll also see on here skilled nursing facilities and home health care. Medicare does provide some coverage for skilled nursing facilities. It's typically very limited because this is for medical care, not for long-term care. So it's usually during the first 100 days in a nursing home, Medicare will provide some coverage, but not much. And then after 100 days, there's no coverage. So limited coverage on those different things. Yes?
Is that within a single calendar year? In other words, do these benefits roll over? If you were in nursing home the first quarter of this year, will you get this benefit anew for the next year, 2018?
No, it's
One time.
You satisfy it one time, right? Yeah.
And do you have to be institution in the hospital for the days previous?
Yes,
There's
yes,
a qualification there.
Right. And I think in order to qualify for the skilled nursing facility benefits, you have to be hospitalized for 3 days before being transferred to the skilled nursing facility. And so for a lot of people, it doesn't happen.
No.
Okay. Now, this is always changing, and there are exceptions to everything. People tell me all the time, oh, well, Medicare pays for my home health care, or Medicare paid for, somebody else's nursing home. There are always exceptions, even though there are rules. When you pick up the books on these things, there are hundreds and hundreds of pages of different things that you can take advantage of. Especially in New York State and Onondaga County, there are programs in Onondaga County that have been set up like PACE and some of these other programs to actually coordinate care so that you can get additional services beyond what Medicare typically pays. So as you look at this, don't panic and think that there's no other alternative, because very often there are services that you can find through the county that are going to assist you with some of these things that you may run into. So the key is to know that there's always exceptions. Yes?
I mean, I'm being so mouthy.
That's okay.
Where do you find out about these things as you're lying in bed in the hospital?
Well, once you're lying in bed in the hospital, that's the hard part. It's going to depend on a family member, a friend, or a representative who's going to do some of that legwork for you.
Or hope the social worker knows
Yeah,
about the
yeah.
stuff.
Right, yeah.
Sometimes they don't.
Yeah.
Now, how does rehab fit in here? Like, say, suppose you're in the hospital and then they send you to a rehab facility, and how does that operate?
Well, I know typically when you're released from a hospital and you're going to a rehab program, most rehab programs are 14 days. And I believe the reason they are is because that's what Medicare will cover. And then beyond that 14th day, it usually goes to home rehab or home physical therapy, where they'll pay for based on the doctor's plan of care, they'll pay for a certain number of days of rehabilitation. Yeah, great question. Okay, Medicare Part B. This is what we use most of the time. Our doctors, going to the doctors, preventative benefits, durable medical equipment. It carries a monthly premium, and right now, we'll talk about the premiums in a minute, but this has a deductible of $183. So if you, and this is on a yearly basis, it resets each year. You pay your deductible, and then after that, you begin to pay for the doctor. 20% co-insurance on doctor services and outpatient care. And this is what you tend to use the most. This is where you present your Medicare card at the doctor, and then billing is taken care of directly from there. This is a little bit small because this is actually right off Medicare's website. But this is Medicare Part B. This is the part that you do pay for. And so right now, if you're a single individual and your earnings are your income is $85,000 or less, you're paying a monthly Medicare Part B premium of $134. And I can also tell you there are some exceptions to that. There are people that are paying less than that. I don't know all the ins and outs of why some people pay less, but they do. If you are making above $85,000 up to $107,000 of income, your premium jumps up to $187, and then you can see based on income, at the highest income level, there's a premium contribution of $428 per month. So this is varies based on income. Some people, while they're still employed beyond age 65, are not required to pick up Medicare Part B until they actually leave their employer. And other people are required to. So there's some rules there as well. Okay, probably one of the more confusing parts of Medicare is the prescription drug coverage. And there's a Medicare Part D. These are the plans where basically the way it works is that Medicare is going to pay your costs for prescription drugs up to about $3,700 per year. Once you go beyond $3,700, then you go into what they call this donut hole. And this is where Medicare does not pay for your prescription drugs. You still pay a reduced rate negotiated by Medicare, but for the most part, this is maybe your biggest prescription drug expense. And this is going to vary for everyone as to how much you're going to pay out of pocket. But it can be anywhere from $4,000 to $6,000 that you're going to have to pick up for the cost of prescriptions. unless you have a drug plan that's already covering it. So this is an area, again, that probably is best, depending on what prescription drugs you're taking, is that you're speaking to a representative who either sells these coverages or works for a company who does consulting on it, so they can make sure they get you to the right plan. Okay, so understanding the costs, Medicare Part A, as I mentioned, no cost. That part everybody gets for free. Medicare Part B, in 2017, the monthly premium is $134. So your annual cost is $1,600. Medicare Part D, premiums are, vary, but around $40 per month. And then the average price of a Medigap policy or a supplement are about $185 to $200. So the total per person on a monthly basis can be anywhere from $350 to $400 to $500 per month. If you're on an Advantage plan, that's different. It's typically much less expensive because everything is included in that. And then if you multiply that by 2 for a couple, you could be looking at $700 per month, which is about $8,600 per year. So when we look at those numbers, if we go back to the beginning, that $200 and some thousand in healthcare costs, over the course of 10 years, just in premiums alone, you could be spending $86,000 in a household. And then 20 years, you're at $160,000, $170,000. That doesn't even include your deductibles and your co-insurances. So that's where those numbers come from. But again, depending on your income, some of these things may be lower, some may be higher. So if you are not retired yet and you have the ability, some of the things that you can do to save money to pay for healthcare costs in retirement are things like flexible spending accounts, dependent care flexible spending accounts, and probably the fastest growing account is the health savings account. And that's an account that you can save for on a pre-tax basis, put money into that, and then when you retire, you can actually bring that money with you into retirement to pay premiums, co-pays, deductibles. But like anything else, it requires that you fund it. So, there's trade-offs to everything. Some employers fund them, but not a whole lot that I've run into. And in my case, we use ours up every year. With 3 kids, very rare that any money stays in there.
Isn't it true that with the FSAs versus the HSAs, that if one of the partners, one of the spouses is goes on Medicare, they can't be in an HSA, but they can still participate with their employer on FSA?
I'm not aware of that, but it's possible.
Yeah, I think there's a change in the law.
Yeah, it could be. I don't know the answer to that, I'm sorry. But so there are some tools out there, but again, each one has some limitations and some exceptions to it. Nationwide, who I saw this presentation done recently, they actually have an assessment. If anyone's interested, you can just ask me afterward. They just have a form that you can fill out and answer a couple dozen questions, and they'll give you a proposal to show you what your expected health insurance costs might be in retirement. And it just looks at if you're single, if you're married, if you have any health conditions, what kind of costs you might incur. So it's not going to give you anything that's probably going to change how your coverage is handled, but it can give you some little insight as to what it might cost down the road. All right, the next piece of it, and for some couples, for some families, this can be one of the largest costs, is long-term health care insurance. Or not long-term health care insurance, but long-term health care. And this is really defined, and this goes right into, or comes right out of Medicare. Long-term care is different from traditional medical care. Long-term care helps one live as he or she is now. It may not help to improve or correct medical problems. Long-term care services may include help with activities of daily living, home health care, respite care, hospice care, adult day care, care in a nursing home, or care in an assisted living facility. And those activities of daily living, those are some of the key things as you get into the long-term care world. They look at things like eating, dressing, bathing, toileting, transferring, the ability to get in and out of a chair. Those are your activities of daily living. And doctors are often making decisions as to whether or not you qualify for benefits based on your ability to actually perform those activities of daily living. Now, the other thing that comes into play is the next thing, which is the Alzheimer's and cognitive impairments. Those are the biggest things that are being measured when it comes to long-term health care. So I get the question, and this is fairly often, at least in my client base, people, when I ask people, what are your plans, what do you want from a long-term care planning standpoint? I'm not talking about insurance, I'm just talking about as you go forward, if you were to need care or your spouse to need care, what's important to you? And the answer, I hear almost all the time, well, at the very least, we don't want to lose all of our money unnecessarily. And I think what the unnecessarily refers to is the questions that you're asking is, what is out there? What can you do? And so that's really some of the things that we address. As we get into this, we look at the costs here, and this is kind of hard to read, but this is put out by the New York State Partnership for Long-Term Care. And this goes on a county by county and region by region basis. And they're telling us here what the average nursing home costs are. So if you needed nursing home care, the central region here, which includes Onondaga County, the average cost for care is $304 per day, which is $111,000 per year. Now these are big numbers, but I can tell you from clients that are receiving care, these are the numbers, and in many cases even higher than this. So certainly home health care typically is less expensive because you're not receiving 24-hour care. You might be receiving a few hours a day or a few visits a week. Assisted living, because you're not receiving 24 hours care, is typically less expensive. So this is, nursing home care is the extreme, and that is the place that probably most of us want to be the least. And typically the government wants to keep us out of the most because it is the most expensive. So my experience has been to date that very often government programs, government services will do what they can to keep people in their home, in their own environment, and do it as inexpensively as possible. So I show you this so you can kind of see where the numbers come from and get an idea of what the costs are. And it varies here in Syracuse from, at the upper end, $13,000, $14,000 per month, to the lower end for nursing home care, probably around $9,100, $9,200 per month.
What would be two examples of those living situations? On the high side is who?
Well, Loretto, certainly if you're on the top floors where they have very high-end living accommodations, you're paying more for that. So that's typically, if you're in a private room in most nursing homes, you're in the $9,000 to $10,000 per month.
What would be that, an example of that facility?
That would also be at Loretto on any other floor other than that special floor that they have up on the top. Yeah. And do you have some other examples?
I was just gonna say most places I would say are pretty equitable, just
Right.
depending on, like you said, the privateness of the room, whether
Right.
you have your own room or you're sharing or
Yeah.
if it looks more like a hospital-like room, depending on
Right.
what room you choose.
Yeah, and you can find within these facilities, some of the floors look more like, the Taj Mahal, and that's what you're paying for. So you want solid wood every place, you're paying more for that. Okay. All right, so those are the numbers, and it varies. You get down to New York City, you're up at $400 per day, costs of $150,000 per year for long-term care. So who pays for it? Right now, and this graph is probably 4 or 5 years old, Medicaid, which is a joint venture between the states and the federal government, pays roughly half of all long-term care costs. Medicare pays about $42.2 billion, which is about 20%. And people always ask here, well, I thought Medicare didn't pay for much. Well, what happens is it's the volume or the number of people needing long-term care for a short period of time that Medicare pays for. So they pay something during that first 100 days. So it's very common for somebody leaving a hospital to go into a nursing home. Doesn't mean they stay there very long, but that's picked up by Medicare.
That's called rehab, when they go.
Right, rehab, yep, typically, yep. Yeah, and then there is skilled nursing facilities, so if you're actually receiving medical care in that nursing home, that typically is covered in part as well. But if it's just long-term care, meaning you're not receiving a doctor's care, then that's the part that's only covered for that first 100 days. Out of pocket, meaning people just writing a check from their checking account, about 18% of the total cost, or $37 billion per year. And then other public, other private, those might be foundations and things like that that are established to cover people. And then private health insurance and long-term care insurance make up for about 7.3% of total care. That percentage is rising, even though fewer people are purchasing long-term care insurance. The number of people who are going on to claim are increasing because they bought policies 10, 15, 20 years ago. So the percentage being paid by private health insurance is going up. So that's that piece right there. New York State has a program called the New York State Partnership for Long-Term Care, which basically says that if you buy a policy that they've approved and it meets their requirements that says you have a certain level of benefits, and you use that policy and you exhaust the benefits, meaning you use up all those benefits, that New York State will step in and pick up through Medicaid your ongoing costs after that time period. So you don't have to buy a policy that covers you forever, but you do have to buy a policy that covers you for a period of time adequately in New York State's regulations and their view. So that's one of these, that falls under some of these other programs that are out there. So we'll go back to that because this is really, and this is more just a discussion about long-term care insurance. This is probably, if you need long-term health care. So if you are going to receive care in a nursing home, in your home, or wherever it might be, and you're looking for the best possible solution to pay for that care, if you had bought a long-term care policy, it is absolutely the best way to pay for that care. If you bought adequate coverage, and typically if you buy it from a company in New York State, those companies tend to pay their claims without too much effort. It's been our experience that we've had very few clients who have ever filed a claim that were denied. So it is really the best way to pay for your care. However, it's an underwritten product, which means you have to be in good health in order to get it. The second thing is, and a big deterrent to a lot of people, is that you could pay your premium for 30 years, you pass away, and you get nothing back. And while we can say, hey, well, if you needed it, you had it. And that's true. But for a lot of people, it's the idea that they're laying out those dollars and not getting anything back. And then the next thing that has become a big problem in recent years are that the premiums are not guaranteed to stay level. They can increase those premiums, and they have. So pretty much across the board, any policyholder in New York State in the last 5 years has probably received a premium increase, and they've ranged anywhere from 11% to 400%, depending on who you bought the policy from. And so oftentimes what happened is people were buying policies back in the 90s that were very low cost relative to other companies. thought it was a great deal, but then 10 years later, they're getting premium increases that are a couple 100%, doubling, tripling their premium. Now, we haven't seen a lot of that, but it has happened in New York State. And the reason that's happening is because the people are filing claims at a rate much faster than the insurance companies ever anticipated. The average claim is filed within 3 years of purchasing a policy. Now, that doesn't mean that the average person files 3 years after buying a policy, but the average person who does file a claim is filing within 3 years of the purchase of that policy. So what that means, I don't know. The insurance companies have an idea that people feel, hey, something's going on here, I'm gonna buy a policy. I haven't seen that, but it's certainly possible.
How much does it cost for a policy?
Well, depending on your age, you're typically looking, a 60-year-old is probably looking at an annual premium of about $2,000 per year for $100 per day of coverage, which is $3,000 per month of benefit.
About
Yes.
65.
65?
Yeah.
You know, I mean, I'd be guessing, but you're probably looking at closer to $3,000 for every $100 per day of benefit that you purchase. Yes.
What age do you recommend individuals to look into long-term care? Because of course, I mean, like myself, I could be seeing how many people do end up using long-term care. I could go
Right.
get a policy now.
Sure, absolutely.
But when is the best age?
Well, I mean, ideally, I think what drives it, and I mentioned this earlier, is that for most people, during our working years, we're focusing on saving for retirement. We want to make sure we have enough life insurance, enough disability insurance, enough health insurance. So long-term care typically is pretty far down the list to get it. But if you're able to pick up a policy, you know, in your late 40s or early 50s, that's when it's going to be the least expensive. And you'll probably still experience a premium increase at some point, but you're starting out with a premium that's so much lower than if you waited until 60 or later. So, I mean, that's the ideal situation. And what I recommend to a lot of people, you know, if you look and say, okay, long-term care in Onondaga County costs $300 per day. You don't have to buy a policy that's going to cover you for $300 per day. But it would help if you had a policy that covered some of that expense. So it's not an all or nothing. I view it as any other insurance, which is, you know, you want to cover what you can, but you don't need to cover every last dollar of it. So in many cases, you know, I see younger people in their late 40s, 50 years old, just buying a policy that covers $100 per day, with the idea being that if I need care, there's going to be something there. And the reality is that most of us don't go from no care to $11,000 per month. We go from no care to 1 day a week, you know, which might be $100, to a couple days a week, 6 months later, to a couple, you know, weeks out of the month. So very often I find that my clients wade into it, and their costs might be under $20,000 for care for the first couple of years before it escalates to a point that they need nursing home care. And so having those smaller policies allows them to, you know, cover those smaller years. Yes?
Sorry, I have a ton of
That's
questions.
okay.
So long-term care insurance will cover assisted living care as well,
It will,
correct?
yes, yeah. Yeah, the only thing it doesn't cover is rent. So, you know, and that is something that's important to differentiate. Some of these senior communities, they are not designated assisted living facilities. They may have a wing that is designated for assisted living, but if you're just there for the senior living community, it may not pay anything. But once you move to the assisted living area, then it begins to pay for your care.
But it pays for your care, it doesn't pay for your living expenses, so to speak. They allow,
That's right,
I
yeah.
mean, you may be paying $90 a day for your food and board.
Exactly, that's right, yep, you're right. Yep.
And then they don't pay for that, they pay the other part that you get extra.
Yep, they pay the costs that are designated as not medically necessary, but related to assisted living. Yeah, good point. So these are the reasons that we're seeing fewer people buy long-term care insurance, rising premiums, concern about the companies that are still in the business. Genworth, being the largest in the business, as I mentioned, was purchased by a company from China who has put a lot of money into them to stabilize things and back those claims. I think that's a good thing. But other companies, Mutual of Omaha, Transamerica, still in the business, still doing well because they have so many other lines of business, and it appears that they'll continue to stay in that business. But other companies like MetLife have gotten out, and some of the bigger carriers that were in it. And I think even Mass Mutual might have just stopped selling it as well. CNA, yep.
They're still, yeah.
Well, CNA was, their business was taken over by Travelers, which was taken over by MetLife, which has been taken over by Genworth, which has been taken over by somebody in China.
Okay.
So,
It's like selling mortgages.
yeah.
So I still write my check to CNA, so I.
Yeah. Yeah. So that's really, and this is what most of us think of when we think of any potential for long-term care insurance. But today, what we're seeing more and more of are these new, what are called asset-based solutions that are cropping up. And these are really, you know, and if we look at, this is more, as I look at a typical client, they may come in, and this may be you. You've got a certain amount of money in investments and in qualified retirement plans like IRAs, 401ks, that type of things. You might have a certain amount over here that's in savings at the bank and cash reserves. You might have some life insurance and then some other assets, your property and other things. And you may have even gone so far to say, you know what, I've got X amount of dollars set aside to pay for healthcare costs during retirement. And that's carved out of that little gold box over there. So everybody's different, but this is kind of a common scenario. Your slices may be bigger or may be smaller. And there may be some that are zeros, but this is commonly what we see. So the way these asset-based products work is that you take a chunk of money and you give it to the insurance company. And the insurance company says, based on your age, based on your health, and based on how much money you gave them, if you need long-term health care, we're going to pay an amount greater than what you gave us for your long-term health care. And we'll go through an example in a minute. But they're going to pay a benefit on a monthly basis to cover your care. It might be 4 years that they cover, it might be 6 years. That's typically what we see. If you never need long-term care, they pay death benefits, which again is an amount greater than what you gave them. So if you pass away before you need long-term care, your beneficiaries receive a death benefit, like a life insurance policy. And then the last thing is, if you change your mind, they give you your money back. So for a lot of people, these type of solutions are beginning to become more popular because basically what they're saying is that whether you live and need long-term care or you die or change your mind, you or somebody else is going to receive some benefit. So it overcomes some of the problems with traditional long-term care insurance. And if we look at an example, in this case we have Gloria, she's age 64, good health, got $250,000 in her IRAs and $125,000 at the bank. She decides that she wants to take $50,000 of that savings at the bank, and she's going to reposition that. And basically what it does is that $50,000 will provide $3,200 per month of long-term health care benefits for 6 years. So we've taken $50,000 and it has created $234,000 of potential long-term care benefits if she needs long-term health care. The second piece is if she passes away, or when she passes away, if she hasn't used the long-term care benefit, the $50,000 creates a $114,000 death benefit. So puts $50,000 in, 3 years later, passes away, the $50,000 is actually $114,000 in death benefit that goes to spouse, family, whoever you want it to go to. And then the third thing is, if Gloria changes her mind, we'll give her $50,000 back. So this is, every company is different. These are just some examples of some numbers for a 64-year-old female, but it gives you an idea of some of the options that insurance companies and investment companies are beginning to offer that are a little bit more attractive. And people look at this and say, the thing that is most interesting to me is I get my money back if I change my mind. And so that, I would say, is the number one thing that drives people to do this. I'm willing to take a piece of my savings, I'm willing to allocate it to this type of plan, knowing that if a couple years from now, or a lot of years from now, I need my money back, I can get it back along the line. And then, worst case scenario, you need long-term care that pays a benefit, or if you pass away, somebody gets something. So under any of these circumstances, somebody's going to benefit from it, as opposed to traditional long-term care insurance where, you know, we perceive that as being a premium we just pay and you never benefit from if you pass away.
Is that considered an asset if you apply for Medicaid?
That's a great question. It is an asset. And one of the things that we've actually seen, a couple of lawyers have actually recommended this to their clients, with the idea being that, you know, if they have money that they need to protect, and again, I'm not an attorney, but this would provide some benefit for them for 5 or 6 years while they begin to move assets into a trust or do some other kind of planning. But yeah, it is because it has a cash value, it is going to be an asset from a Medicaid planning standpoint.
Is five-year look back going to 10 years?
I haven't heard that, but it's certainly possible. Is that something you heard?
Well, speculation.
Yeah.
It went from 3 years to 5 years and
Right.
3 years back.
Yeah, and the question, the look back period, essentially, in order to qualify for Medicaid, you have to reduce your assets, your investments, your real estate, anything you own, you have to reduce it. And if you're married, I believe that number is somewhere around $120,000 that you have to get it down to. If you're single, it's down under $5,000. And one of the ways people do it is by putting money into a trust, so that their beneficiaries can actually benefit from that instead of using it all to pay for long-term care. And again, I'm not an attorney, but one of the things that Medicaid looks at is that when you transfer money to another person or to a trust, if you go apply for Medicaid, they look back. They look back 60 months from your application date to determine whether or not you've transferred any assets to somebody else. And if you did, then they disqualify you for a period of time where you have to either recoup some of that money or have your friends and family pay for your care. So there apparently is some talk or speculation that 5 years may be increased. And again, I'm not an attorney, so those are things that you'd want to talk to a lawyer about. Okay, so if you live and need long-term health care, this provides benefits. If you die, it provides a death benefit. If you change your mind, you get your money back. And this is the driving force. There are now, up until a year ago, there was only one company in New York that offered this. As of today, there's probably 4. So good companies, good plans, they all offer different benefits. Some have a cash value that grows more quickly and has a lower long-term care benefit. Others have a very high long-term care benefit but a low cash value. So it just depends on what's important to you. The downside, these are also underwritten. So you have to be in good health to qualify, not as good a health as if you were applying for life insurance. They do take into account some health conditions, but if you've applied for long-term care insurance already and been declined, you cannot apply for these policies. Okay.
Is there a waiting period before they become effective?
It varies from company to company. Most of them have either a 0-day waiting period or a 90-day waiting period. So the most is 90 days. And here's the other thing that's unlike long-term care insurance where your premiums can go up, these can't. It's a one-shot deal, your benefits are guaranteed. So it's not, you don't find out down the road that things are different than what you started with. Okay. The next thing is life insurance. And we all think, and one of the things in the description of this course mentioned that you may have some assets now that can be used for long-term care planning that you really haven't thought about. And one of the biggest is life insurance. We tend to, in the financial industry and as individuals, as we age, we think in terms of protecting our kids with life insurance. So by the time we get to 65, we don't need life insurance anymore, right? Because the kids are on their own. But oftentimes, what we find from a planning standpoint is that life insurance can provide a benefit that's available for a survivor to pay for long-term health care. So when you think about life insurance policies, again, this is a I say a common scenario. This is an actual scenario. Bob and Mary, both age 65. They came in, combined IRAs, investments, and savings of $400,000. They were currently pulling out $20,000 per year as needed for retirement. Bob had a $150,000 life insurance policy, and Mary had a $100,000 life insurance policy. And the first question they asked me is, should we keep those policies? The kids are doing well, they're on their own, I don't think we need them. And so what we looked at is, and this had happened previously, if a client needs long-term health care, as I mentioned, they typically don't go from no care to $100,000 a year of care. But we had a client back in the late 90s, needed care beginning at age 74, $35,000 a year for care in year one. The second year it cost about $50,000, third year it cost $85,000, and year four he happened to pass away. Their costs for his long-term care were $55,000. The total 4-year cost for his care was about $225,000. Now they didn't have any long-term care insurance, so they actually paid for his care. After spending down and one market correction, they had about $175,000 left when Bob passed away. Mary's Social Security at Bob's death. If you're married, the lower of the two Social Security benefits goes away. So she retained his benefit of $24,000 a year. Her $15,000 went away. But the $150,000 death benefit that he kept actually replenished part of the portfolio and brought it back up. Not fully, but this was their decision, not my decision. So in our minds, we didn't know that they needed the life insurance. They decided to keep it. Having that additional life insurance into retirement replenished the portfolio after Bob passed away. So for some of you, as you're looking to plan going forward, some of those life insurance policies that you may have out there, they may be good tools, things that you don't have to pay for something new or something you've already got, but can be really used as an asset to pay for care, or at least replenish assets for the survivor. All right? And I know that everybody's different in how they look at this, but more and more what we're finding is how can we find something that can do double duty? Instead of having a life insurance policy, an IRA, a savings, and a long-term care policy, maybe we can use something you've already got with the idea that being, God forbid somebody needs care, when they pass away, some of those dollars will come back into the pool to protect the survivor. All right. Any questions on that? Okay, so it's just looking at that death benefit in a different way. One step further, and these are relatively new as well, within the last 10 years in New York State. This is having access to death benefits or life insurance death benefits during your lifetime. So instead of waiting to death to collect, Many companies today offer what's called a long-term care rider or a chronic illness rider on life insurance policies that they issue. And they're typically referred to as hybrid policies. They look just like regular life insurance policies, but with the long-term care rider, you can access those benefits during life, typically at a rate of 2 to 4% per month. So if you have a $100,000 death benefit that has this rider, and you needed long-term health care, you could access anywhere from $2,000 to $4,000 of that death benefit, or of that $100,000 death benefit, to pay for your care. So here's an example. Individual buys a $200,000 death benefit with a 2% long-term care rider. They need home health care. They file a claim. The policy, the insurance company advances them $4,000 per month, as long as they've been certified by their physician as needing long-term health care to pay for their care. And that benefit is paid for up to 50 months. 50 times 2 is 100. That means 100% of your death benefit has been used. So at the end of the 50 months, typically there's no death benefit or long-term care benefit left. But let's say that this individual uses it for 12 months and then passes away. 12 times 2 is 24, right? So $24,000 of the death benefit has been used for care, or in this case $48,000 because it's a $200,000 policy. The remaining death benefit of $152,000 gets paid to the beneficiary. So it literally reduces the death benefit as it's used for long-term care. Yes?
Yeah, and these things are used for home health care or something.
Absolutely, yeah.
Does the health care, does it have to be, can you hire anybody, or do you have to go through an agency?
Great question. It varies from company to company. Some companies offer what's called an indemnity benefit. And what that means is that once your doctor certifies that you are qualified for long-term health care, they're just gonna send you a check each month, equal to 2% of the death benefit. You use it however you want. Whether your care costs $1,000 per month or $4,000, you can receive all $4,000 of death benefit. Other companies work on a reimbursement basis, which say that you have to actually incur costs before they pay you. And more often than not, you have to pay a certified home health care agency to provide your care. So it's worth, if you're going down this avenue to look at these products, it's worth knowing the difference. Because certainly, either way, having one, doesn't matter which one, is better than nothing. But if you're able to get a policy that's gonna pay you the benefit regardless of how you use it, it gives you more flexibility in how you pay for your care and receive your care. So again, $200,000 of death benefit, in this case divided by 4,000, that's your 50 months. At that point, your benefit is exhausted. Same attraction here, which is that if I pass away without using it, somebody gets the death benefit. If I need long-term care, I get the long-term care benefit. What you don't get with this is a return of your premium if you decide that you want your money back. But because you're paying for this over time as opposed to in a lump sum, it's a trade-off. All right, so it's cost effective, it's paid no matter what. And again, the key thing here that I hear from a lot of people, the benefits and the premiums are guaranteed. So they don't change. You may already have some benefits. We look at this oftentimes. A lot of people have existing policies. Maybe they bought policies when they were young or even when they weren't young. But those policies may have some cash value in them. You may have it's not uncommon for people to have 4 or 5 small policies. You can combine those and use those to buy a new policy if you're in good health. Or you can just buy a policy outright. But here's a pretty common scenario. Mary's age 65. As part of her retirement planning Her advisor looks at her life insurance. She has a life insurance policy with a $20,000 death benefit and a $17,500 cash surrender value. She has savings that she'll plan on using for her long-term care if she needs it, but also wants to consider her options. This is a policy here, what we looked at, and this is kind of hard to read, but we used $17,500 from her existing policy. We rolled it over into a new $100,000 policy with a long-term care rider, and because we front-loaded it with the money in that old policy, she was able to get a $100,000 policy with a monthly premium of only $133. And that offers her $100,000 of death benefit, $2,000 of monthly long-term care benefits. So again, it covers nursing home, healthcare, hospice, assisted living, and adult daycare. The idea being here is if she goes from nothing into a nursing home, it's not going to cover everything. But if, like most people, she kind of gradually eases into it, it's going to provide some benefits. If she passes away without using it, her beneficiary is going to get $100,000 instead of the $25,000 on the other policy.
With,
Yes.
with this type of situation, if you wind up using the insurance for long-term care, will it eventually wipe out the insurance?
It will, yeah,
So that if the person dies, there may be no insurance?
exactly, yeah. Yeah, so in New York State, most of these policies do not have a residual death benefit. So if you use all $100,000 for long-term care and you pass away, there's nothing left. Outside of New York, most companies offer a 10% residual death benefit, but for some reason, New York did not approve that. And so those become a trade-off. You know, what assets do we use to pay for long-term care? This gives you an option, but I'm sure there will be some people that will say, you know what, we'll use something else we have to pay for care. I'd rather that we have the death benefit in place if mom passes away or dad passes away. So those are decisions that people will make down the road. All right, so this has to do with making sure that you review what you have. And I focus on this a lot because I find people buying new things when they might already own something that is going to do what you need it to do. So the first thing is, if you own life insurance policies, take a look to see if they have either a long-term care benefit rider or a chronic illness rider. Chronic illness is much more common, but that is something that was commonly issued on policies in the last 15 years with no cost. So you might already have a policy that has some of these benefits. Next, is your existing policy going to last? This has to do with cash value policies. A lot of people bought policies back in the late 80s, early 90s when interest rates were 14, 15%. Today, with interest rates at 1%, your policy may not be performing as well as you think it is. So if it's not a guaranteed policy, you want to look to make sure that your policy is going to be there when you want it to be. So it's also possible if you have a term insurance policy, you may be able to convert it to a permanent policy without any medical underwriting. So if you have a lot of people go into retirement with, they still have large term insurance policies, you may be able to call that company up and say, hey, I want to look at an alternative to my term insurance, something that I can keep forever. And that's typically called conversion. You can almost always do that without any medical underwriting, so you don't have to be in perfect health to do that. If you want to add the long-term care rider, you might have to be in good health to do that, but you still might be able to make that conversion to a permanent life insurance policy. All right. So this is why I talk about this again on life insurance. 70% of all life insurance policies reviewed in our office, which over the last 15 years has been about 3,000 different policies, are performing so poorly that they're going to lapse prematurely without a substantial increase in premium. That does not apply to whole life, but it applies to other cash value policies that do not have a guaranteed death benefit. So if you have a policy, one of the first things you can do, take a look at your annual statement, see what the cash value was at the beginning of the year versus the cash value at the end of the year. If it's going down, that means your policy, the cash is running out over time. If it's barely going up, that means it probably will start going down soon. But if it's going up regularly, then your policy is probably okay. But one of the things you can do is ask for an in-force illustration from your insurance company to show you how is this policy expected to perform. And they'll show you what the plan is going forward. You don't care what it's done, just what it's going to do for you in the future. All right? And this is basically because of interest rates. So premiums were based on interest rates and on projections, and because rates have gone down so much, we're beginning to see these, well, we've been seeing them fall apart for years, but they're beginning to accelerate. And this is typically what you might see. Might have a policy, $250,000, you're paying $1,098 per year for it. And as far as you know, everything's okay. You get an illustration from the company, and what it shows you is that the policy's not gonna last. You wanna know this as soon as possible so that you can take action to fix it, or find a new policy. So we'll skip over that. This is really a formal policy review. I refer to this as a free money strategy, and this is not for everybody. But this is, oftentimes, you know, we hear about people who need more dollars in retirement. If you own your home free and clear, and you plan to stay in your home, one of the things I hear from people all the time is, oh, I want to leave my house to my kids. Well, there's a pretty good chance that your kids don't want the house as much as you think they do. But the cash that's in your house might benefit you, but you don't want to leave it. One of the things that you can consider is a reverse mortgage to help with long-term care expenses. Basically, the way it works is that, and we'll go through an example, but it's a home loan that allows you to convert the equity in your home, or part of it, to cash. You don't have to repay that loan unless you sell the house or you pass away. All right, that is the major attraction to these loans. It's also the major deterrent, because in people's mind they think, well, I can't leave my home now. You still can, but if you take the cash out of it when you sell it, you're not going to get any cash when you sell it. So you have to weigh the pros and cons. So it's not for everyone, but it is worth examining. Mary, age 67, Bob, age 69. Home in Canolas valued at $140,000. No mortgage or line of credit on the house. They plan to remain in their home, and they want long-term care benefits. All right. They met with somebody at a bank, and these calculations for reverse mortgages are guaranteed by the federal government. So the federal government makes the calculation, and what they tell them is that they can get a reverse mortgage, or in this case, on their $140,000 house, they can get a lump sum loan of $86,000. This amount, this $86,000, that's a loan against their home. It's going to go up each year by the amount of interest that's not paid. So the bank is still charging interest on the $86,000, but you don't have to pay it. It just gets added to that $86,000 each year. All right. So you took the $86,000. You can do with it whatever you want, and that loan continues to grow as long as you're in the house, or as long as you're alive. So this is a non-recourse loan, and what that means is that if you're in that house, say you live for 30 more years, and the $86,000 loan grows to $200,000, but your house is only worth $150,000 at that point, they have no recourse on you. They have to accept the proceeds of the sale of your home. So you pass away, whoever handles your estate sells your home for $150,000, the $200,000 loan is wiped out. All right? So you don't have to worry about the loan growing to an amount greater than the value of your home. So again, this is a tool that allows people to access some of the cash. I typically don't see it with people in their 60s, unless they're in poor health and they really need to get at that money. And the way it works is that the older you are, the greater the amount of the loan you can take. Because the bank is looking at it saying, we'll give you $120,000 if you're 85. Because, you know, our expectation is that you're not gonna be in it very long. If you're 65, they're gonna give you less money because you could be there for 20 years without paying any payments or interest.
I have a question.
Yes?
Now, if you did one of these reverse mortgage loans, isn't it important, like, if you were married, to have both people take out the loan, because otherwise
Yep.
they could kick out the other person that's left after the person that took out the loan died?
Yeah, I don't know about that, but I do know that if you're married, and again, I'm not an expert on these loans, but I believe if you're married, both people have to remain in the home. But there's a lot of good reverse mortgage information around. Most of the banks have somebody who's very well educated in these products. In this case, Bob and Mary wanted to use the $80,000 to essentially go back, buy those life insurance policies that we mentioned before. In this case, because Mary is a female and was in a little bit better health, we used $30,000 of the reverse mortgage for her, $50,000 of Bob's, and basically we're able to get them into a $150,000 life insurance policy, which has a monthly long-term care benefit of $6,000, and their annual premium was only $1,200 because some of that mortgage money was used. Now, I'm not recommending that you run out and do this, but these are just some of the options that you'll find that planners are trying to help people figure out ways to get some coverage. Okay, so in this case, $140,000 home. The money was used to create $300,000 of death benefits, $300,000 of long-term care benefits. Bob and Mary can still live in their home without having to worry about paying off that debt. And the reality is, if they decide to sell, they can. If that debt has increased, whatever they sell their home for, they have to pay off that loan. So they get less cash out of it, but they use the cash for something else. Okay, so the real risk here for most people is planning so that we don't outlive our money. And this is a cartoon that I've had in a lot of presentations. I'll let you guys read that. If your vision is like mine, I'll read it for you. It says, if we take a late retirement and an early death, we'll just squeak by. And that's certainly not the way we want to plan, but that's, okay. Last thing I want to talk about, and then we'll just kind of open it up for questions, because I know I've covered a bunch of of different things, but I wanted to get as much out there as possible. None of those other things apply to you. You don't want them, whatever the case may be. Just having a specific plan for how you use your money in retirement, investing in different time horizons, and the order that you use your money may impact your long-term care and the dollars that you use them. And the reason I say that is because certain dollars are exempt from that Medicaid formula, while other dollars are not. So if you're married and you're both in your home, and one of you needs long-term health care, your home is not included in the Medicaid qualifying formula, all right, up to $750,000, I believe. In addition to that, your IRAs and your 401ks are not included in that Medicaid qualifying formula. So for that reason, I've heard some attorneys recommend that you spend non-IRA money. Spend your savings, spend your regular investments before you spend money that came from your 401k or came from your IRAs or your 403b, because they have more protection in the event that you needed to go into a nursing home and you wanted to qualify for Medicaid. I'm not an attorney, but it's something to ask about in the event that you meet with an attorney to do some of this type of planning. All right. Okay, so we've covered a whole bunch of different things. Really just scratched the surface of a lot of them. What questions do you guys have?
If you have these partnership programs and end up spending it all, then you go for Medicaid then. What about, how are our assets protected? They advertise they are, but are
Right.
they, and which ones or whatever?
Sure. That's Medicaid is essentially a joint federal and state program that provides health care benefits to people who are, in their term, I believe, is indigent, meaning that they have no financial means. If you just go apply for Medicaid, you have to have very low assets and very low income. All right, so there's two pieces for it to qualify. One is your asset level and your income level. And I don't know those off the top of my head. But what a partnership plan does is it says if you buy a 3-year long-term care partnership policy, 3 years being the benefit period. So you buy the policy, you pay the premium for 10 years, you go into a nursing home, and for 3 years that policy pays for your care, it runs out of benefits. Now at that point, you can apply for Medicaid to provide coverage for your care without regard to your assets. So you could have $2 million in the bank, and when they go to calculate whether or not you're eligible for Medicaid, that's off the table. They can't count that in the formula. They still can count your income. So if your income is over the Medicaid limit, they're going to request that a certain percentage of your income be contributed towards the cost of your care. And you can actually get that right on the New York State Partnership website, or you can, email me or call me. But I think the number is around, if you're receiving, you can have up to, I think, $2,100 or $2,500 per month of income, and qualify for Medicaid if you're married. That number is much lower if you're not married. I believe it's like $50 per month. But so what they say is that under the New York State Partnership Plan, if your income is greater than $50, they request that you contribute your income, but not your assets. So your assets are protected, your income is not.
That would be a monthly spend down?
Yes,